FHA. FHA and condos, I'll leave that for a different topic, but FHA in itself, a lot of the big banks will not go over a 50% debt-to-income ratio. I had a phone call about, it was in January of this year, and it's a listing agent, or an agent that I work with in Somerset County very, very closely. And she called me, she was listing a property, and she got a decline letter from the lender that the buyer was working with. So she said, before we accept this decline letter, I want you to talk to Dan. And so I spoke to the person. I met him at Dunkin' Donuts in Somerville, went through all their tax returns, and in about 8 hours I figured out, okay, I can make this work. His debt-to-income ratio was 57%. Now, there were compensating factors. He had a 740 credit score. He had 10% down. The reason why his debt-to-income ratio was 57% was because he worked for a plumber, and in the last 3 years, 2 out of the last 3, he went on unemployment because the plumber couldn't afford to keep him on the books and keep him employed, essentially. If that's typical, like with union employees, we can count the unemployment as income. Well, the loan officer that the person was working with before was counting the unemployment in the income. And when it got to the underwriter, they said, oh, sorry, 2 out of 3 years, this isn't normal. We'll call up the employer. No, I don't normally send them on unemployment. That was just a couple rough years. Wrong answer. They declined. So what I did was I took the unemployment out, averaged it over the 3 years, explained it to the underwriter that this wasn't typical, that his 2011 tax returns were more up into the 45,000. We're using 36, 35, but that's why his compensating factors were 57% debt-to-income ratio. We got it approved, closed in 30 days. So if you have those situations, don't take the kill letter yet. Have them call me. Not all of them are going to work. All right? I mean, there's going to be stuff we're going to try to stick to the wall and it's going to fall off immediately. But if there's something there that we can feel confident. I used to be an underwriter, so I put on my underwriting hat, I look at it, and I write up a credit memo to my underwriter and say, here's what I think, here's why I think this loan should be approved. And sometimes they'll call me up and go, crazy. And I'll say, no, this is why I feel this way. And sometimes I'll win, and sometimes I won't. But I'd say, if you're a betting man or woman, you should bet on the times that I will win. Because I'm not going to put that into the system. I'm not going to set your expectations that this is going to be okay. And then 3 weeks, 4 weeks later, call you up and go, sorry, I can't do this either. I'm going to tell you within a couple of days. So you're going to know, and then you're going to be able to move on. Okay? So again, those are some of the things with the debt-to-income ratios where I'm seeing and receiving phone calls. This bank or this lender or this in-house lender didn't do this because of, and sometimes we make that work. So that's pretty much my presentation. Again, I wanted to keep this simple. I don't want you to be the experts. I want you to send them to me if you do run into those issues. One man's trash is another man's treasure, and I'll take that all day. Does anybody have any questions? Yes?
Tell me about the 97 LTV conventional, because I didn't know that existed.
Yes. Tom also works at Mortgage Master here, and there are also situations where with 3% down, we can get mortgage insurance. So this is better than FHA. On a conventional mortgage. On April the 9th, FHA increased their mortgage insurance premiums. It went from 1% to 1.75, so it almost doubled. The monthly mortgage insurance went up to 1.25%. They multiply it times 1.25 divided by 12, and that's the monthly. So if you do that calculation, and you're buying a house, in the first 5 years on FHA, you're paying over 7.5% to FHA, just to get the mortgage. With decent credit scores, it doesn't have to be 760. I mean, it can be 660, 670, 680. But there can't be a lot of derogatories. You can't have a $14,000 judgment from the state of New Jersey for not paying your taxes. I mean, you gotta be somewhat clean in that perspective. But 3% down, the mortgage insurance is only the 1.2 for the entire year. If your credit scores are all the way down to a 620, if they're over 700, that number definitely drastically reduces. So it's so much more affordable for your homeowner. And also with condos, there's potential that we can work with that into that 3 to 5% range without having to do, because I'm sure you guys are seeing the FHA condominiums are just, it's insane how horrible it is. 60% of the new applications to FHA are being declined for not having 10% of their annual budget going to the deferred maintenance account. Too many homeowners being delinquent on their association dues. When they fill out these forms and send their financials in, 60% are being declined by FHA. So if you've got somebody who says, oh, I only have 3.5% down, you may want to have them give me a call just to see if that 3% number works, because they're going to be able to afford more of a house because their mortgage insurance is going to be less. And for every $50, that's in today's interest rates, every $50 less in payment is $10,000 more in purchase price. So, I mean, that's going to work. I mean, sometimes that 10,000 is that go, no go. That is definitely, thanks Tom for bringing that up, with the 3% down and the mortgage insurance, we can definitely do that as well. And I don't know about if we can get it all the way up to 50, but we can definitely go over the 41, 42, 43 overlays that some of the other lenders are doing. Any other questions? Yes.
The first and second to avoid PMI, is that common nowadays? I know it used to be, and then wasn't, and then very difficult to get.
Like the 90-10-10?
Yeah.
They are around. They're not as popular as they once were.
Mm-hmm.
And I am a product of that personally,
Mm-hmm.
where it's actually hurting me trying to refinance
Mm-hmm.
because I've got this second,
Right.
on a personal perspective. I'm a mortgage insurance guru. I will tell somebody if they call me up and say they want to put 20% down, I'll say maybe we should put 15% down. Save that other 5. We'll buy a single mortgage insurance premium. You don't have to pay it on a monthly basis. You pay one lump sum, 1.25% of your mortgage amount. Boom, it's over. And you're breaking even in 28 months versus paying this for the next 7 years. I love mortgage insurance as a tool to be able to put somebody in a better position. But we do have them, especially here in Mercer County where the loan limits are 417. I mean, you can hit a driver in a 5-iron and be in Somerset County in some places. Sometimes it's just a sand wedge and you're in Middlesex County.
Mm-hmm.
And with that, I mean, you have people who share the same school district, West Windsor, Plainsboro. Plainsboro goes up to 625.5 on the loan limit. West Windsor's 417. So that's huge difference. What we're doing with that is we're splitting up that first to 417 and then giving the rest in the second. So we are getting creative with that.
Okay.
But to avoid the mortgage insurance, I personally feel, because mortgage insurance, I mean, I have a guy who's doing a $300,000 loan amount. He's putting 10% down, so he's buying it for around $330,000. And the mortgage insurance single paid premium is ballpark about $3,800.
Mm-hmm.
He never has to pay mortgage insurance again. Whereas if we did a first and second, he now would have a $30,000 second mortgage to pay off. Yes, he'd have a lower loan amount on the first, but he's still got that $30,000 second. And we don't know what the IRS, what the government's going to do with second mortgages anymore as far as tax deductibility. I pretty much bet they're going to take away second homes, and people over $1 million aren't going to be able to have, taxable. That's another topic. But that allows him to now have that full mortgage of $300,000, completely tax deductible, and only pay $3,800 and never have to pay mortgage insurance again. So it's really, I actually teach loan officers how to do this, because it's not, they just.
The terms also used to be a lot better for a second mortgage, like there were interest-only options and stuff like that. Now you're getting really, if you're doing a second mortgage, you're gonna be paying like 8-10% on a second versus 4%. before it used to be able to look at it and it might have made sense or it was close. Now it's, you know, if you're going the PMI route, it's gonna be better depending on the depending on the scenario, but for the most part, the PMI is gonna be better.
You know, the single paid premium, is that, it has to be paid within the first year, you said?
It gets paid at closing.
Get paid at
Mhm.
closing.
So, and just again, to use simple numbers, you're buying a house for $100,000. You wanna put 20% down. You're gonna do a mortgage for $80,000. Versus putting 15% down, you're going to now put, you know, 15,000 versus 20. So you've got $5,000 in your pocket. If it's 1.25% of your mortgage amount, so 1.25% of $85,000 is going to be, we'll call it $1,500, $1,600. You've still got $3,400 in your pocket. So your water heater goes. You've got money to replace it. You know, it gives more flexibility. I mean, cash is king right now. And at these low interest rates, why would you, that's what I tell people, why would you want to put all your money down on your house at a 3.875% interest rate? I mean, it just doesn't make sense to me. But I'll let you do it if you want to. I'm not going to tell you no. But that's how I use mortgage insurance as a tool in that perspective. It's due at closing, one-time payable, boom, it's over. Unless you refinance later on in life and you don't have the equity, then you have to figure out your mortgage insurance. But that's the same if you were taking it out monthly or not. So. Any other questions?
Yeah, do you have any lenders, I mean, is this the best we can do, saying Pike Run, and I'm very happy to have the 15%, not complaining. But, is there anything you can do with other lenders for buyers who don't have it, but otherwise have a strong financial status?
Good
and
question.
The only thing on that kind of questionnaire that is a negative is the litigation.
Yes.
But everything else is fine with the financial.
Unfortunately, the answer is no today.
Yeah,
And just to pull you all into this, Pike Run up in Belmead has been in the litigation for about 4-5 years now.
Not quite, maybe about 3.5 or so. but-
Still, it's a long litigation. I sat down, I pulled it from the Somerset County Clerk's office, sat down and read it, and you would think if you drove by it was flat on its face. I mean, the attorneys did a great job talking about construction deficiencies. The problem with that litigation is that it talks about construction deficiencies. So from a lender's perspective, why would I want to give you $300,000 on a house that may fall over? Right? Even though it's all been completed and all the construction
And
deficiencies
there
have
was
been
never
issued.
any structural damage to begin with.
There wasn't, but when you read it, and you'll agree
Yeah,
because you
yeah,
read it
yeah,
as well.
yeah.
So that type of situation, no, the 15% down is the best option
And
that
it's
we have.
wonderful.
It is,
but, you know.
and there's no mortgage insurance on this, by the way,
Yeah.
with 15% down. There's no single pay premium. There's no monthly. This is all built in, so it's 15% down. Now the rate's not 3.875. It's more in 4.6, 4.7. But when you look at 15% down in mortgage insurance, that blended rate would have been close to that anyways. So again, just to reiterate with Pike Run, not now. Hopefully that litigation will be finished out. But, any other questions? All right. Guys, thanks so much for coming in. I really appreciate your time, and I hope that this is something that has educated you. It's not as doom and gloom as the media says it is. And if you hear the word no from a lender, from a buyer, pick up the phone, call me. I work weekends. I work when you do. All right. So, thanks so much.
Thank you.
It's Nadia this morning.